Clear to close, and her investment property loan got approved. The email lands on her phone at 2:47 p.m. while she's sitting in her car outside work on lunch break. She reads it twice. Then she starts crying. You see, 12 months ago, this same borrower was told her credit was too bad to ever buy a rental property. Today, she just got approved anyway. Let me show you what her credit report looked like. Late payments, collections, and high utilization highlighted in red across multiple cards. Credit score, 585. Banks call this subprime. Loan officers call it unqualified. So how does someone with late payments, collections, and what every conventional lender calls bad credit end up getting a rental property loan approved without waiting years for a perfect score? That's what this video is about. In the next few minutes, you'll see exactly how she did it, step by step. And you'll learn the 3 specific loan paths that let people with bruised credit still become rental property owners. Let's get into it. If your credit score starts with a 5, then you've heard this story before. Someone applies for a rental property loan and gets a call from the bank. Application not approved. Traditional bank reps talk as if a certain minimum score is a hard cutoff for any mortgage approval, as if there's no workaround or alternative, no path forward, until that 3-digit number crosses an invisible threshold. But here's what they're not telling you. Different loan programs have very different rules. Non-QM lenders, DSCR products, and even some owner-occupied programs operate with completely different thresholds and compensating factors than the conventional bank underwriting you just got denied by. This video is about how real borrowers with imperfect credit actually get rental property loans approved by choosing the right loan type, stacking the right compensating factors, and sometimes letting the property's income qualify them instead of their W-2s. Let's translate the shame of bad credit into something concrete lenders actually look at. Historically, many conventional loans treated scores below 620 as too risky. Full stop. But automated underwriting systems now look at the whole file. And Fannie Mae has begun removing strict hard minimums for many conforming loans if other factors compensate. FHA versus conventional makes a huge difference here. FHA guidelines let borrowers with scores of 580 or higher buy with about 3.5% down. Borrowers between 500 and 579 can sometimes be approved with around 10% down if other requirements are met. Now, connect that to the rental property context. FHA and similar programs are designed for primary residences. But here's the loophole. A 2 to 4 unit purchase qualifies as owner-occupied if you live in 1 unit. That means you can buy a duplex, triplex, or fourplex, live in 1 unit, and rent the others. It's a house hack. And it's how many investors with rough credit get into their first property. Here's the big idea that changes everything. Lenders look at more than one number. They're looking at compensating factors. Down payment size, debt-to-income ratio, cash reserves, rental property cash flow, and even consistent rent payment history can pull a weak score across the finish line. Think of it like a scale. On one side, credit score. On the other side, down payment, reserves, DSCR, income stability. If your score is light, you load the other side heavier until the scale balances. There are 3 primary paths people with bruised credit use to get approved. Path 1, use more forgiving owner-occupied programs, the house hack. Path 2, use a DSCR loan where the property itself qualifies based on rental income, not your personal credit. Path 3, borrow someone else's credit through a co-borrower or use portfolio lenders willing to trade higher down payments for lower scores. Let's walk through all 3. The borrower from the opening didn't start with a pure rental loan. She bought a duplex as her primary residence using an FHA-style loan. Then she rented out the other unit. FHA loans allow 3.5% down for scores at or above 580. 10% down for scores down to around 500, assuming other guidelines are met. FHA is generally more forgiving than conventional when it comes to lower credit scores and past issues. That's why experts steer weaker credit borrowers toward FHA instead of Fannie Mae conventional. And here's the house hack twist that makes it work for rental investors. FHA can be used on 2 to 4 unit properties if you live in 1 unit as your primary residence. That means you can own a small apartment building and qualify for the easiest loan terms available. Here's how her story played out. She pulled her credit and realized conventional banks wanted a higher score and bigger reserves than she had. So she pivoted. She targeted a small duplex where projected rent from the other unit would lower her effective housing cost to almost nothing. The lender approved her via FHA because of three things: recent on-time payment history, verifiable income, and enough down payment, even though her score was still in the high 500s. Now, let's talk about DSCR loans, the investor cheat code where the property's income does the heavy lifting instead of your credit score. DSCR stands for Debt Service Coverage Ratio. It's simple math. The property's monthly rental income is divided by the total monthly payment. Principal, interest, taxes, insurance, HOA, if applicable. Most DSCR lenders look for a DSCR of around 1.0 to 1.1 or higher, meaning the rent covers at least 100 to 110% of the mortgage payment. Here's the key advantage. DSCR loans often do not rely on tax returns or W-2s. They underwrite primarily based on the property's income and market rents. For investors whose personal credit is messy but who can find strong cash-flowing properties, this shifts the question from "can I qualify?" to "can this property qualify?" Many DSCR programs require mid-600 scores, like 620 to 660 or higher, but they explicitly market that they can look past lower scores if other compensating factors are present: higher down payments, strong DSCR numbers, and solid reserves. Let me show you a sample scenario. Single-family rental, market rent, $1,500 a month. Total monthly payment including taxes and insurance, $1,300. DSCR 1.15. That ratio allows approval even though the borrower's score is only 620 with some old collections still showing. Now let's talk about the trade-offs. Higher interest rates, often 20% or more down. Possible prepayment penalties. And these loans are for non-owner occupied income-producing properties only. This isn't cheap money, but for someone locked out of conventional lending, it can be the bridge between someday and actually owning a rental this year. Sometimes your credit alone won't get the deal across the finish line, but someone else's will. Co-borrower strategy works like this. You add a co-borrower with a stronger credit profile, spouse, parent, investing partner. Even before Fannie Mae relaxed some minimums, lenders could sometimes get around score cutoffs this way. Late payments and recent collections can still kill deals even with a high-score partner. But strong co-borrowers, plus compensating factors like big down payments, solid income, and reserves, can tip borderline cases into approval. Then there are portfolio and non-QM lenders. Some local banks and non-QM lenders keep loans on their own books or use private capital. That lets them set more flexible rules around credit scores in exchange for higher rates, fees, or required equity. For a borrower with bruised credit, a large down payment and good cash reserves can convince these lenders to accept a lower score than a Fannie or Freddie box would. Here's an example. The borrower with bad credit brings the deal, finds the property, manages the rehab and tenants, but a partner with strong credit signs on the loan and receives a preferred equity split. It's a trade-off. Now let's talk about what still gets you denied even on these flexible paths. First, recent derogatory events like very recent late mortgage payments, fresh collections, and ongoing major delinquencies. These can lead to denials even with FHA or flexible lenders because guidelines focus not just on score but on recent payment behavior. Then there's overextended debt and thin reserves. Extremely high debt-to-income ratios or zero cash reserves make lenders nervous, especially on risky investor or non-QM loans where they're already pricing in more risk. There's also DSCR specific traps where if projected rent is too low relative to the new payment, the DSCR falls below the lender's cutoff, often around 1.0 to 1.1. That makes the loan ineligible even if your credit score is acceptable. Here's what our borrower did in the 6 months before she got approved. She didn't magically jump from 540 to 780. She made targeted moves that improved her file just enough to unlock better loan options. She paid off a small collection that was still showing active, cleared a disputed error that had been dragging her score down, and paid down a key revolving balance to drop her utilization below 30%. Her score bumped from 585 to 608. That put her over a critical threshold her lender had mentioned, and it changed the conversation. Let's go back to that email. Clear to close. Investment property loan approved. Here's what it took to get there. She used Path 1, the FHA house hack. Bought a duplex, moved into one side, and rented the other. Her score at approval, 608. Not perfect, but approved. Here are the full numbers. Purchase price for the duplex was $225,000. The down payment was 3.5%. $7,875. Estimated closing costs, $6,000. Total cash to close, roughly $14,000. Rent from the other unit, $1,100 a month. Her mortgage payment, $1,500. Her out-of-pocket housing cost after tenant rent, $400 a month. Before this, she was paying $1,300 in rent with nothing to show for it. Now, she's paying $400 and building equity in a property she owns. Same person, almost the same score and completely different outcome. Bad credit doesn't mean never. It just means you can't play the easy level. But if you understand how lenders really think about scores, income, and the property itself, you can still get to the closing table. That's all for today, and see you in the next one.